Imagine someone asks you to pay like $9,400 a year for a specific service.
Okay, yeah, that's a lot of money.
Right. You're considering it, but then someone else taps you on the shoulder and offers you literally the exact same service for like $400 a year.
I mean, you would instantly think the $9,000 option was a scam.
You would laugh them out of the room. But the crazy thing is, in the life insurance industry, millions of people sit down and willingly choose that $9,000 option every single day.
They do. And they don't just choose it randomly.
Yeah.
They are often aggressively persuaded into it.
Oh, absolutely.
They walk out of the office convinced they are making the most responsible financial decision possible for their family's future.
And today, we're finding out exactly why that happens. So, welcome to today's deep dive. I'm putting on my data-driven optimist persona today to present the Daily Fiscal Audio Analysis Framework.
Love the framework.
Thanks. Our source material today is this fantastic piece called The Math of Mortality: Why Term Beats Whole Life. And our mission for this deep dive is really clear. We want to empower you by decoding the aggressive sales tactics of the life insurance industry.
Right, specifically testing that widespread myth that buying term life insurance is just, throwing your money away.
Which is a myth heavily subsidized by the industry itself, by the way.
Oh, 100%. And to dismantle it, we really need to look at the fundamental architecture of these financial products, not just the marketing brochures they hand you.
Exactly. And the core concept we are using to dismantle it today is something I like to call the great unbundling.
Okay, I like that. Unbundling.
Yeah. Think about those hybrid utensils you get at fast casual restaurants. The spork.
The spork, yeah.
It's trying so hard to be a spoon and a fork at the exact same time, but structurally it has to compromise, right?
Right, the tines are too short to actually stab a salad.
Yes. And the bowl is way too shallow to hold soup. It just fails at both jobs. And honestly, whole life insurance is the financial equivalent of a spork.
Wow, that's a perfect way to visualize it.
Yeah.
Because you are taking two entirely different financial functions, right?
Exactly.
You've got insuring your family against the catastrophic risk of your early death, and then you've got investing your capital to build long-term wealth. And you are cramming them into a single product.
Never mix your insurance with your investments. They serve completely different purposes.
They really do.
But to understand why unbundling them is so crucial, we kind of have to understand the psychology of the buyer. We have to look at why that spork sounds so utterly convincing when you are sitting across a mahogany desk in a broker's office.
Oh, the mahogany desk pitch.
Yeah, set the scene for us. What is the actual pitch they give you?
So the pitch is brilliantly engineered to target your deepest anxieties. The broker will slide this high-gloss brochure across the desk, right? And they sell you on the promise of absolute permanence.
Which sounds great.
It does. They'll say, look, term insurance is temporary. It expires after 20 years, leaving you with absolutely nothing. You're just renting your coverage.
Renting your coverage. Ouch.
Right. But whole life guarantees a payout no matter when you die.
Which hits right at the emotional core. I mean, nobody wants to feel like they are just renting their family's security. It sounds incredibly comforting.
It is comforting.
Yeah.
But then they pivot from emotion to what sounds like, sophisticated finance. They start layering on the cheat codes.
Oh, boy. Here we go.
They explain that a portion of your hefty monthly premium actually goes into a proprietary cash value account within the policy.
Right.
The agent will excitedly tell you that this cash value acts as a forced savings account. They'll point out that you can borrow against this money tax-free. They literally use phrases like,
you are becoming your own private bank.
yes, becoming your own private bank.
I mean, the phrasing alone is so seductive. As a data-driven optimist, I genuinely love the idea of building wealth. But numbers tell a story, and marketing often hides it. So when we strip away the high-gloss brochure and look at the actual mechanism of the policy, what is the reality check here?
The reality check is found in a metric called the internal rate of return, or IRR. In simple terms, this is the actual annualized growth rate on that cash value portion of your premium.
Okay.
And the narrative completely unravels when you look at this number, because the return is frequently abysmal. For the first decade or more, we're often talking about returns that barely outpace basic inflation.
Wait, why is it so low? If I put that exact same money into a basic index fund, historically it grows significantly faster. What is dragging down the return inside this policy?
Colossal administrative fees.
Oh.
Yeah. The fundamental structure of whole life is incredibly expensive to maintain. But here is the mechanism you really need to understand. Historically, the entirety of your first-year premium on a whole life policy goes almost exclusively to pay the agent's commission.
Hey, wait, the entire first year?
Almost all of it, yes.
That is, to put that in perspective, imagine buying a house, but your real estate agent takes your entire first year of mortgage payments straight into their pocket as their commission.
Exactly. You build zero equity in your house for 12 months.
That's insane.
That is exactly what happens with whole life. You dig a massive financial hole in year one just to pay the person who sold you the policy.
Right.
And then you spend the next decade trying to crawl out of that hole with a subpar growth rate.
Okay, let me push back on this, though. I want to play devil's advocate for the person who just bought one of these policies.
Sure, go ahead.
You mentioned earlier that the agent pitches this as forced savings. And I know human nature. Human nature is incredibly messy.
Oh, very messy.
We get a bonus, and instead of investing it, we buy a boat. Or we take a trip to Tulum. Isn't a forced savings mechanism, even with high fees and a terrible first-year commission structure, isn't that better than trusting people to diligently invest on their own for 20 years?
I see where you're going with this.
Right, like at least with whole life, the money is locked away and growing. And when I die, my family gets the massive life insurance payout plus that big savings account I was forced to build up.
And that assumption right there,
Yeah.
that is what leads us to the industry's quietest, most closely guarded secret.
Oh, what is it?
It is a harsh contractual truth. If you die with a whole life policy, the insurance company historically pays out the guaranteed death benefit,
Okay.
but they absorb the built-up cash value.
I'm sorry, they absorb it. They keep my savings account.
They keep it. You rarely get both the death benefit and the cash value.
How is that even structurally possible or legal? If it's presented to me as my private bank and my personal forced savings, how can they just keep it when the policy pays out?
Okay, so here is how they justify it mechanically. The cash value isn't actually your money in the way a checking account is your money.
Okay.
Structurally, it is the insurance company's reserve fund to offset the rising cost of insuring your mortality. Think about it. Insuring a 30-year-old is cheap. Insuring an 85-year-old is incredibly expensive because death is imminent.
Right, the risk is way higher.
Exactly. As you age, your risk to the company skyrockets. So, as your cash value goes up over the decades, the actual net amount of risk the insurance company is taking on goes down.
Wow.
When you die, they just pay the face value of the policy, utilizing the reserve you spent your life building up to fund a huge portion of that payout.
That is staggering. So the very thing they are selling you on, this whole forced savings private bank concept, it just evaporates for your heirs the moment the actual insurance contract is triggered.
Yep.
You are essentially self-funding your own death benefit and paying them a massive premium to do it.
Precisely. It is the ultimate heads we win, tails you lose scenario for the issuer.
Okay, I think we have thoroughly broken down why the spork fails. So recognizing that the investment side of whole life is fundamentally flawed,
Right.
we need a strict mathematical framework to see what happens when you separate the two.
We need to unbundle.
Yes. We need to isolate your mortality risk from your wealth building.
And the math here is where this deep dive gets really illuminating. The sources provide a fantastic case study. We have this hypothetical scenario with a woman named Sarah.
Okay, let's talk about Sarah.
She is a 32-year-old non-smoker, and she has carefully calculated that she needs $1 million in coverage to protect her family if she were to pass away unexpectedly.
Got it. Let's run the options for Sarah through the daily fiscal audio analysis framework.
Let's do it.
Option A is the whole life policy we've been discussing. The quote, for a permanent $1 million death benefit comes back at roughly $9,430 a year.
That is nearly $800 a month. For a 32-year-old, that is a massive, suffocating financial commitment.
It's a second car payment, maybe even a small mortgage payment depending on where you live.
Yeah, exactly.
Now let's look at option B, which is unbundling the risk. She looks at a standard 20-year term life policy for that exact same $1 million in coverage. The quote for option B comes back at just $416 a year.
Wow.
Let me just repeat the scale of that difference for you. Option A is $9,430 a year. Option B is $416 a year.
The chasm between these premiums is universally massive across all coverage amounts. The source actually provides a secondary example just to prove how it scales.
Oh, right.
A $500,000 policy might cost $5,280 a year for whole life, compared to a mere $340 a year for term. The mathematical gap is staggering.
In Sarah's case, that gap is exactly $9,014 annually. I really want you to think about that $9,000 premium difference, not just as a monthly expense, but as a lifestyle tax.
The lifestyle tax, right?
That is money that is legally yours, generated by your labor, that you would be voluntarily handing over to an insurance company to fund their reserves and pay their commissions. So, what happens if Sarah refuses to pay that lifestyle tax?
This is the fun part.
Let's simulate what happens if she takes that $9,014 and treats it as an active investment rather than an insurance premium.
This brings us to the core thesis of the entire deep dive. Buy term and invest the difference. What happens if Sarah buys option B, the cheap $400 term policy, and takes the $9,000 she saved every single year and aggressively deploys it into the market?
Right. And the sources suggest using broad, low-cost index funds held inside a tax-advantaged account.
Yes.
And just for clarity, when we say index funds, the sources mention ticker symbols like VOO or IVV. We aren't talking about day trading speculative tech stocks or trying to time the market here.
No, I'm not at all.
These are exchange-traded funds that simply track the S&P 500. You're essentially just betting on the collective growth of the 500 largest companies in America.
Exactly. It is a transparent, highly liquid, low-fee investment. So let's crunch the numbers on Sarah's simulation. She invests that $9,000 every year. We need a hypothetical growth rate, so let's be conservative and assume a 7% annualized return over 2 decades.
Let's walk through this timeline, because compounding interest really needs a moment of reverence.
It's magic.
It is. At year 5, she's put in about $45,000 of her own money. The market has ups and downs, but she's building a foundation. Now, going back to my earlier pushback about discipline, she has to actually leave this money alone. She cannot buy the boat.
That is the one critical variable. She must have the discipline to let it compound.
Right.
If she does that consistently, letting that 7% annualized return do its work, we arrive at year 20. Sarah's brokerage account would conservatively project to roughly $394,000.
Nearly $400,000. And unlike the cash value in a whole life policy, this money is entirely hers. It is liquid. It is accessible.
Completely hers.
If she passes away at year 19, her family gets the $1 million from the term life insurance plus the nearly $400,000 she built up in her brokerage account. The insurance company doesn't absorb a dime of her investments.
That is the power of unbundling. But the real revelation, the absolute aha moment of this framework happens the following year, year 21.
Okay, let's slow down and look really closely at year 21 because remember the broker's initial mahogany desk pitch.
Oh, yeah.
The primary scare tactic against term insurance is in 20 years, your policy expires, you have no coverage, and you threw all that money away.
Right.
So Sarah is now 52 years old. Her term policy has officially expired. The insurance company is out of the picture. According to the broker, this is the absolute nightmare scenario.
Is it? It is the exact opposite of a nightmare. Let's look at Sarah's actual life circumstances at age 52.
Yeah.
First, she has nearly $400,000 in highly liquid assets sitting in her portfolio. Second, her financial liabilities have drastically plummeted. Her kids, who were toddlers when she bought the policy, have likely graduated and are self-sufficient.
They're out of the house.
Yep. The massive mortgage she had at 32 is likely mostly paid down or significantly reduced. Her peak earning years are behind her, or she is currently in them, meaning the need to replace 30 years of future lost income has basically vanished.
Think about what that actually feels like. She wakes up at 52. And she has achieved the ultimate goal of personal finance. She has built foundational wealth.
Exactly.
The reason you buy life insurance is to protect against the financial devastation of a lost income when you have high debt and zero assets. But at year 21, Sarah has low debt and high assets. She is now effectively self-insured.
Self-insured, that's the key.
She no longer needs the $1 million death benefit from a corporation because her family's financial foundation is secured by her own net worth.
That is the profound elegance of buy term and invest the difference. You buy the cheap term insurance precisely for the decades when you are most financially vulnerable.
Right.
And you use the massive premium savings to systematically build your own wealth so that by the time the insurance expires, you don't even need it anymore. You outgrow the need for life insurance.
It is an incredibly empowering mathematical reality. But playing the data-driven optimist here, I have to look at all the data points.
Fair enough.
I cannot just dismiss a multi-billion-dollar product category entirely without asking, why does whole life even exist? If the math so overwhelmingly favors term insurance for someone like Sarah, is whole life just a 100% scam across the board? Or does someone, somewhere, actually have a structural need for it?
It is a great question. It is not a 100% scam, but the use case is incredibly, almost vanishingly narrow. We call this the 5% exception.
The 5% exception, okay.
The most important paradigm shift for you to understand today is this. Whole life insurance, when used correctly, is an estate planning tool. It is not a working-class wealth-building tool. For roughly 95% of Americans, term insurance is the only logical, mathematically sound choice.
Okay, so who makes up that remaining 5%? Who are the people who actually should be sitting in that mahogany office signing on the dotted line?
There are three highly specific specialized exceptions outlined in the data. The first bucket is ultra-high net worth individuals who exceed the federal estate tax exemption.
Okay, how rich are we talking?
To put some real numbers on that, we are talking about individuals with estates currently sitting above $13.61 million in 2024.
Wow, okay.
Now, that number is subject to sunset provisions and could be cut in half in 2026, but regardless, we are talking about multimillionaires.
And mechanically, why do multimillionaires need whole life?
Because of liquidity.
Mm-hmm.
When they die, their heirs might owe massive estate taxes to the federal government. A whole life policy provides immediate, guaranteed tax-free cash to pay Uncle Sam.
Oh, I see.
Without that immediate cash payout, the heirs won't be forced to fire sale the family business or liquidate a massive real estate portfolio at a loss just to cover the tax bill.
That makes complete sense. It is a very specific, high-end tool for a very wealthy, complex problem. What is the second exception?
The second bucket is for families who have a lifelong special needs dependent.
Oh,
In these heartbreaking but very real situations, parents know their child will never be financially independent. They need absolute certainty that a specific amount of money will be there to fund an irrevocable trust for that child's daily care.
right, regardless of whether the parents pass away at age 40 or age 95.
Exactly. And crucially, they need that money guaranteed, regardless of whether the stock market is in a massive depression that year. Whole life provides that absolute, unshakable guarantee.
The certainty is absolutely worth the premium in that scenario. That is a profoundly valid use case. And the third bucket.
The third bucket involves complex corporate structures, specifically business continuation or what is often called key man corporate insurance.
Key man insurance.
Yeah. Imagine two partners own a highly specialized multi-million-dollar manufacturing company. If one partner suddenly dies, the surviving partner needs immediate cash to buy out the deceased partner's shares from their grieving spouse.
Right. Otherwise, things get messy.
Exactly. If they don't have the cash, the spouse might force a sale of the company. So again, whole life provides guaranteed, permanent liquidity for complex business transitions.
So if we look at those three exceptions, estate taxes for the ultra-wealthy, lifelong special needs trusts and complex corporate buyout structures, the takeaway is incredibly clear.
Very clear.
If you do not fit into one of those three highly specialized buckets, you are almost certainly dramatically overpaying for coverage you do not need. If you are a standard household trying to pay off a mortgage, put your kids through college, and eventually retire with some dignity, you are the 95%.
Exactly. And the central philosophy we need to distill from the sources is that the insurance industry thrives on complex opacity.
Yes, opacity is their best friend.
By combining pure mortality risk, which is statistically very cheap to insure, with an opaque, low-yield savings vehicle, they manufacture a reason to justify excruciatingly high premiums.
But now that you have the mathematical proof and you know exactly how the mechanics of these policies work, it is time to turn this framework into action. We don't just want to give you the math, we want to give you the playbook.
The playbook is keeping your insurance pure and cheap and putting your investable cash into transparent, highly liquid, low-fee index funds. It remains one of the most battle-tested financial principles of the modern era.
So if you are sitting there realizing you need to make a switch, maybe you are abandoning a whole life pitch you just heard, or maybe you are looking at a policy you already own and realizing you need to transition to term, here is your 3-step action plan.
Step 1.
The first thing you have to do tonight is figure out your actual number. Calculate your exact coverage need. The general consensus from the data is to multiply your gross household income by 10 to 12.
Good rule of thumb.
Then add in any outstanding massive debts, like your mortgage, and throw in expected future liabilities, like what you want to contribute to your kids' college expenses. That total number is your target death benefit.
Once you have your number, step 2 is to shop the aggregators. Do not just go to one single captive agent who only sells one company's product.
Right, because they are incentivized to sell you their specific spork.
Exactly. Use neutral comparison platforms, the sources mentioned, sites like Policy Genius, to pull 20-year term quotes from multiple carriers. And as you review those quotes, make sure you are filtering for highly rated carriers, specifically looking for an AM Best rating of A or higher.
Let's explain that rating real quick. Think of AM Best like a credit score, but for the insurance company itself. If you are buying a promise that might not pay out for 20 years, you need to know with absolute certainty that the company won't go bankrupt in the meantime. An A rating means they are financially rock solid.
Precisely. And that brings us to the third and most important step. Automate the difference. This is the behavioral hurdle.
The biggest hurdle.
Calculate the exact dollar difference between what you are going to pay for whole life and what your new term policy costs. You must set up an automatic recurring monthly transfer from your checking account to a brokerage account for that exact amount. You have to actually invest the difference for the math to work.
If you buy term and just spend the difference on lifestyle creep, the broker's warning actually comes true. You will arrive at year 21 with no insurance and no wealth. You have to deploy that capital into the market to build your foundation.
It has to be automated.
Now, as we wrap up the daily fiscal audio analysis framework for today, as a data-driven optimist, I have to give our standard but very important reminders. The framework and concepts we provided today are purely educational, based on research and analysis of our sources. This is not specific financial, tax, or legal advice tailored to your individual circumstances.
Right. And remember that historical observations and market data, like our conservative 7% return example, are not guarantees of future performance. All investing involves risk, including the potential loss of principal. You should always consult with a qualified financial advisor, tax professional, or attorney before making any significant financial transitions, especially when canceling existing insurance policies.
Absolutely. And while our sources may earn compensation from affiliate partnerships, as they disclose, it does not change the mathematical reality of unbundling your risk from your investments. Which brings me to a final provocative thought I want to leave you with. Something for you to mull over as you go about your day.
What's the thought?
Think back to the beginning of our deep dive. Think back to that mahogany desk and the broker looking you in the eye, telling you that term insurance is just throwing your money away.
Okay.
Imagine if the massive first-year upfront commissions that insurance agents receive for selling whole life were required by federal law to be disclosed as an exact dollar amount right on the signature page of the contract.
Oh, wow.
Imagine if right before you picked up the pen to sign, you saw exactly how many thousands of your hard-earned dollars were bypassing your cash value and going straight into their pocket that afternoon. Would the whole life industry as it exists today even survive that level of transparency?
I don't think it would.
Keep asking the hard, data-driven questions. Thanks for joining us on this deep dive. We'll see you next time.